What is fundamental analysis in stock market? Fundamental analysis of stocks is about the analysis of real data of stock to find stock's value. It is the best method to determine the health and growth prospect of the company. In this method, stock's revenue, profit margins, return on equity, future growth, and other data are used to get the company's underlying value and growth prospects. Fundamental analysis of stocks requires analyzing different financial, microeconomic, and macroeconomic factors to determine the intrinsic value of a stock. It involves looking at the financial health of a company as well as taking into account the factors affecting its industry as a whole. For example, the factors determining the price of a stock like demand and supply gap and overall economy of the globe are taken into consideration. How to do the fundamental analysis of stocks? Let's quickly look at some of the best and easy ways to perform fundamental analysis of stocks so that you can pick the selected ones for long-term investments. Initial screening of stocks with the help of financial ratios. First of all, the initial screening of stocks is done to find the right company to invest. You must take care of some important financial ratios of companies before making a decision on investment. These ratios tell a lot about financial health of a company. A ratio in itself does not imply much about a company, but when compared with the ratio of other companies in the same sector, tell huge tales of the financial standing of the company. There are numerous ratios which are broadly categorized into 4 categories. Let us discuss the most common ratios and how they are calculated. Liquidity ratios. They assess the company's liquidity position at any instant. That is, they measure a company's ability to convert its assets into cash for paying off its obligations. Current ratio is equal to current assets by current liabilities. Quick ratio is equal to liquid current assets by current liabilities. Leverage ratios. They assess the overall debt situation of a company. Debt to equity ratio is equal to total debt by total equity. Debt to asset ratio is equal to total debt by total assets. Profitability ratios. They assess the ability of a business to earn profits. They directly show the financial performance of a company. Let us discuss the most commonly used profitability ratios. Operating profit margin, also called EBITDA margin, tells about the efficiency of the company's operating model. EBITDA margin is equal to EBITDA by total revenue minus other income. PAT margin, PAT by total revenues. Return on equity. This is a very important ratio which assesses the efficiency of a company in terms of generating profits for its shareholders. Return on equity is equal to net profit by shareholders' equity times 100. Return on capital employed indicates the financial performance of the company taking into consideration the total capital it employed. ROCE is equal to profit before income and taxes by capital employed. Activity ratios. They assess the overall efficiency of operations of businesses in terms of ability to convert inventories into sale and sales into cash. Inventory turnover is equal to cost of goods sold by average inventories. Accounts payable turnover is equal to net credit purchases by average accounts payable. Working capital turnover is equal to revenue by average working capital. Price to earnings or PE ratio. PE ratio measures a company's current share price to its earning per share. It shows how much a stock investor is paying for each rupee of earning. It also shows if the company is overvalued or undervalued. Generally, the PE ratio is useful for the valuation of stable and mature companies which earns a profit. You must always keep in mind that a company can easily boost its PE by adding debt. So it's better to use past earning for calculation of PE. If you want to know about the ideal PE, you should compare current PE of the company with its historical PE, peers PE, the average of the market, and industry PE. Suppose a company with 18 PE may look expensive when compared to its historical PE but can be a good buy if peers PE is 19 or 20. An average of market and industry PE is 21. Return on equity. The main purpose of any investment is return. How much you will get from your investment depends on the earning of the company, that is, return on equity. If a company is earning a good profit, investors will also be benefited. It helps to compare the profitability of the company in the same industry. Generally, ROE between 15 to 20% is considered good, though a high ROE is expected from a good growing company. Price to book value. This ratio is used to know that if a company goes bankrupt and repays its all debts, then what value will remain with them. It compares the company's market value to its book value. Debt to equity ratio. The ratio shows how much debt is involved in the business of the company by the promoter's capital. A low debt to equity ratio is considered better. Again, a company with low debt to equity ratio is assumed to have more opportunity for expansion due to fundraising. Price or earning growth ratio. As you know that a fast-growing company has a higher PE ratio, one can think that the company is overvalued. So PE ratio divided by the estimated growth gives a result that if high PE is justified or not. It can be compared to competitors with a different growth rate. Number 2, know about the company. The second step of fundamental analysis of stock stocks is to understand the company which you have selected for the investment. If you have little knowledge, you can't decide about the performance of the company, whether the company is performing well or not, what is going on inside the company, what will be the effect of a change in management of the company, whether the company is making the right decision towards its future goal, and lastly, whether you should hold or sell the company. Go to the homepage of the company and check everything like products, business, customers, geography, mission, vision, etc. If you are satisfied, then move to the next step of the investigation. Else, just ignore. Check the financial reports of the company. After knowing all about the company, you should move forward to study financial reports of the company. Study of financial reports in the fundamental analysis of stocks is the most important step. Financial reports include profit and loss account, balance sheet, and cash flow statement. The balance sheet is reviewed to understand the financial condition of the business as of a given period. The income statement is used to understand the profit or loss of a business within a given peak, whereas cash flow is used to understand the flow of cash as of a given period. Thank you for watching.